Join me for an exciting webinar with Supply Chain Brain featuring trade experts from Thomson Reuters, Ernst & Young, and Georgia Pacific. We'll explore key insights from Thomson Reuters' 2023 State of Global Trade Report, provide valuable tips on leveraging global trade technology to support your talent, and discuss the expanding responsibilities of ESG reporting in the supply chain.
We are. Welcome to Freightonomics, the post-Christmas Outlook edition.
Yes.
The
Happy
ME,
holidays.
happy holidays, airing the week between. It's kind of the dead zone for activity in the economy between
Not
Christmas
here.
and New Year's. Yeah. But we got a good show today, a special show. Zach Strickland, head of Freight Market Intelligence, Anthony Smith, chief economist, and we're going to be joined by the rest of the ME squad today. Mike Baudendistel, Henry Byers, getting some intermodal and maritime action in, and some outlooks. Today's going to be all about outlooks for 2024, kind of read the market, etc. But first off, have to thank this month's sponsor, Thomson Reuters. The 2023 Corporate Global Trade Survey report from Thomson Reuters is here, and you don't want to miss this. Navigate the ever-changing trade environment with insights into hot topics like the skills gap, ESG reporting, ongoing and upcoming industry developments, and more by getting your free copy today. Download now at the link on your screen.
And Zach, you mentioned this gets your seal of approval as well.
100%.
You've used it.
Yeah, no, it's
and you're a
legit.
fan.
I got something out of the opening, just the download link, which again isn't saying much for somebody like me. But anyway, well, what do you think?
Kicked off. Yeah, I mean, huge shout out to our sponsors. Thank you so much, Thomson Reuters, for making this show possible. And let's get things kicked off with our first market expert that we're going to welcome on for this special holiday edition of Freightonomics, and that is the one and the only Mike Baudendistel. He is going to be our go-to for all things rail, intermodal, and of course CPG. Mike, thanks for joining us today.
No problem. Good to see you guys.
Yeah, and also People Speaking Rail.
People Speaking Rail.
Yeah,
Also,
Joanna.
another big resource for anything on the financial markets.
Yeah, like a lot of people don't realize you worked in the financial space either. Like it's like you're a jack of a lot.
And really master of all.
Hopefully a master of at least something. Yeah.
Yeah. Yeah. So let's get it started here, Mike. So give us your read on, what's happened with the intermodal rail side of things. And I guess, I would also like to know about the CPG space a little bit as well on what happened this past year that was new or nuanced in your mind that was an interesting development.
Yeah, so I think there was a lot of things that were an interesting development. In most of this year, there was not enough demand that the carriers would like. They were kind of over-resourced. They had plenty of excess containers, and volumes were pretty dismal. A lot of that changed on the intermodal side in the fourth quarter. So fourth quarter to date, I have domestic intermodal up about 5%, international intermodal up about 9%. And when you look at the way intermodal volume, kind of the way that the railroads look at it, which is the last 4 weeks, what's happened in the last 4 weeks, total intermodal volume up 7.5% across international and domestic. So there's definitely been a pickup in demand there. And I think you can attribute that to a few things. I think the main thing is that the service levels have been strong this year. So kind of a departure from the last couple years. So every time I have a guest on the People Speaking Rail or talk to them otherwise about rail service, I always ask them about sort of what they're seeing in the field there, and they've been pretty complimentary, including shippers that had been pretty down on the rails prior to years, particularly CSX. I hear good things about their service. So that's been kind of the biggest thing in the intermodal side. And then you have all of these different collaborative efforts that JB Hunt, BNSF collaboration, bringing quantum back as they talked about on F3, potentially a big deal in terms of expanding intermodal to certain locations where intermodal had not been a big deal, like Phoenix and Denver. Union Pacific also, is going to open up a terminal in Phoenix on the international side. So you're seeing different ways where carriers can expand their volume. You're also seeing more collaboration. And one that I would call out is on the north-south side. We're seeing collaboration between JB Hunt, BNSF, and Freightonomics, bringing intermodal volumes north across the border through Eagle Pass, Texas. The idea is to take a day off the transit time from Mexico to Chicago. So that seems to be a competitive response to the CPKC merger, which has the potential to increased speed, northbound. So I think there's more reasons to think of intermodal as, again, being a growth area within domestic transportation. Again, so I'm more, convinced that intermodal is a growth area again than I was, 6 or 12 months ago, which I think is a good thing. I think next year, intermodal volume likely to be up, barring some service meltdown, polar vortex in Chicago, et cetera, or some big retrenchment in the consumer. But I think if we would have seen a big retrenchment in the consumer, we would have seen that already, not when the stock market's ripping and inflation's coming down. So I think there'll be enough freight to move. On the pricing side, it's a little bit unclear. I mean, we've heard anecdotes, directly from companies rebidding their freight that are saying those shippers are getting price rate declines that will bleed into next year. So some of the anecdotes suggest that we've heard from shippers suggest that intermodal rates will be down next year, but I've heard from an investment fund just yesterday, so they met with a lot of the management teams at the carriers, publicly traded carriers, and they were saying intermodal rates would be flat to up. So a little bit of a difference of opinion. There typically when you go through a fourth quarter when there wasn't any major capacity constraints, you wouldn't have much movement upward in pricing.
Beautiful summary there, Mike. And of course, this is going to be some of our overall outlooks, and I can't let you go real quick before asking you real quick, what do you see on the CPG side? Is there a theme or anything that you're going to be looking for in the upcoming year?
So I think the CPGs have held up well. They really haven't seen a lot of elasticities or people cutting back on those things. I mean, maybe it's a little bit around the margin, but in terms of, they look closely at how elastic certain products are for their price increases, like they have the last few couple of years when they really increased prices a lot. They really haven't seen much volume degradation there. So for the most part, it's just not the first thing that people cut back on. I do think that they have built more resiliency into their supply chain. So all that discussion earlier about we're one disaster away from everything being out of stock. I think it has to be a significant disaster for that to happen. I do think they've done things like diversify their suppliers. Some of them have used more distribution centers than they have, sourcing ingredients from more countries, so they're not going to run out of things. So I think that the CPG companies, which had never had a big issues with delivering those products to the retailers before the pandemic, I think they're in a little bit better shape and they are more resilient than they have been.
Well, I think they definitely feel that way. I do think it's interesting. I mean, Rachel Premack's article is a very good read for most people that are interested in that kind of stuff. And of course, Mike, people can check you out on the Stock Out, you and Grace, and People Speaking Rail to get your updates. Thank you for coming out today, man. I know you got places to go.
People see things to do.
No problem. Always great to see you guys.
All right.
Stage strong. I mean, Mike coming out firing, and we're going to keep that momentum going.
Yeah, we are. We're gonna bring on Henry Byers next to get his hot takes on the maritime space. But Henry's been kind of like active in the economic side too. I mean, I think we've all
goes together.
Yeah, I think all of us here in the space have been, and especially at FreightWaves, we kind of realize like, hey, we can't live in a bubble.
Yeah,
like everything's pretty well connected. And Henry's made some pretty significant calls here in the past. And one of the calls that I want to talk about, and I don't know that you're like, again, timing is what really is important in a call. I think a broken clock's right twice a day, right? So anybody can make a call, but the timing part of that call is what's, I think, the most critical.
Sure.
And, Henry, I think you and I were both aligned here in expecting this third and fourth quarter to be weaker than it's materialized to be from a freight demand aspect and an economic aspect. I was definitely right there with you. But I'd like to get your take here on what has happened and what you've seen here in the second half of 2023 that makes you think that, hey, are we out of the woods in terms of like a downturn, or do you still think that there's a little bit of meat on that bone?
I think there's a little bit of meat on that bone. Personally, there's just a lot of economic headwinds that we had mentioned earlier in the year, I think that you're alluding to, that still, we've yet to overcome, in my opinion. I think if you were to look at the consumer as a whole, you look at things like, car payments, you're looking at student loan payments, you're looking at, what's going on with housing. It's really as expensive as it's been for my generation. We've been in the workforce for around 20 years. And I'm certainly, reminiscent of 2008, 2009 already in some regards, just in terms of what you're looking at with layoffs and things like that. But I think as far as how expensive things are, I have to admit, it's been quite surprising. And I think the fact that it hasn't deteriorated yet still leaves the question in my mind of, how possible is it that we get into Q1, Chinese New Year for container shipping comes and goes, and then it's a little early this year. So between February and April, there's room for significant, drops in volume depending on what happens.
And so, Henry, one of the things I love about getting some information on the ocean side of things is that it's pretty much as upstream as you can get because, of course, one of the big things that we do here in the U.S. is consume, and then we import a lot of our materials, we import a lot of our goods, whether it be from the industrial side or downstream for more of the ready available consumables. But we're looking at things upstream. What are going to be some of the things that you're seeing right now on the ocean side in terms of upcoming activity that we can expect to hit the roads here in the U.S.? And what are going to be some of the expectations you have going into that first quarter?
Well, I think there's going to be some significant strength on the West Coast. I think if you look at the Panama Canal, you look at what's going on, even with this, despite what's going on in the Middle East and the Suez Canal, I still think there's going to be a significant shift back in freight to the West Coast. Just look at the Inland Empire and what's set up out there in terms of the amount of volume they can handle and how quickly they can handle it and how hungry the rails are now for that volume to return. Obviously incentivizing that in a way where I think, most shippers that have the scope to be able to do that, I think will take advantage of that. So it's one of those things where I think the surface side markets, you may wonder for a bit, where's this freight going? The rails are super hungry for it. So that's the first thing you need to consider. Secondly, the inventory that is coming in, I do think that, shippers are starting to play a little bit more of a finer line than I had expected. I expected them to, really bleed inventories as far down as they possibly could. And maybe we're seeing just, that just in case maybe hasn't gone away fully just yet. I think, and like I say, the Panama Canal and just a gradual shift just in how things have been set up for the last decade or two in terms of container shipping. I expect some significant strength on the West Coast in terms of inbound volumes. But again, we're just talking about through Chinese New Year. So once we get into late February, early March, it's really going to be where the rubber meets the road in terms of, what we're looking at there.
Yeah, I kind of want to hammer down on this a little bit here. You were talking about this shift back to the West Coast on the import side of things before the conflict in Gaza and Israel was really taking place. And also really before the Panamax was, significantly hindered. This is before like November, because they were still, clearing, goods through that canal at a decent clip before then. But, obviously the winter happened and it closed it down. Do you think, like, how much of this, if those things clear up, I think the drought is obviously a thing that we can consider will eventually remedy itself. But it's like, once those things clear up, do you think that we're going to see this West Coast stay resilient with this import volume and keep that share?
I think, in terms of the market share, yeah, absolutely. I think short term for sure. I mean, if you backtrack to 2014, 2015, when there were, nowhere near what there was in 2021, but there was still a significant backlog in ships off the West Coast. And so if you think about what happened then, a lot of the same types of trends occurred at that time in terms of more freight getting routed to the East Coast. And sure, you've had some changes economically with people migrating from the West Coast to the East Coast, and just the growing Southeast in general, and what they're able to accommodate as far as volume. But nonetheless, I just think I just continue to go back to when the market's soft and transit times are normal. You see, the West Coast preferred. It's the shortest distance, right? It's the fastest way to get in to the country. So if you're looking at, this just in time, and really the advent of e-commerce at a scale has been happening simultaneously alongside all this. So, in order to accommodate that just in time for e-commerce, I mean, you're looking at a lot of things, a lot of attractive, a lot of attractive points in terms of, why you would be preferring to route to the West Coast. And so when the East Coast was getting talked about time and time again, as far as this is a new trend, this will last forever, I'm just thinking, I'm not so sure, because I mean, you have to consider some of the largest players in the country are very, very heavy in terms of what they operate in terms of assets out there, and the rails I think are the foremost thing to consider. And so when you're thinking about like railing it across the country, this mini land bridge is what probably referred to it probably 10 years ago. I think that is on the drawing board right now, because what you're seeing with West Coast rates is they're not having these Panamax Panama Canal surcharges added to them. West Coast rates have been really stable. East Coast rates have just ticked up another $500 at the beginning of the month. And so when you think about that as well, you're thinking about the Suez Canal potential disruption. So the PTSD from shippers to get to the East Coast right now, in terms of COVID and everything that's happened, Hanjin bankruptcy, and just the past in terms of the trade war, et cetera. They're really making sure they're mitigating risk any way they can. And so all of those things considered, I think the West Coast really becomes a nice option for a lot of shippers right now.
And Henry, as we're looking at to the biggest trends in the upcoming year, we're going to be one of the things that you're going to be watching closely. And maybe it's an indicator, maybe it's going to be some type of an event or a shift in a trend. What's going to be one thing that you're going to be watching closely, where to say, okay, this is a good sign, or okay, maybe pull the brakes back a little bit?
I think we have to be aware of the geopolitical risks that are at stake. I think that's what I'm going to be watching really closely, because I think what's happened there, alongside the way carriers have mitigated capacity with a seemingly new strategy with rejections. We have a data set that tracks the amount of freight they're rejecting, and they've gotten pretty savvy here in the last year, where as they're cutting capacity with blank sailings, which the market's really accepted that they have done and are doing, and have come to terms with that, they're now choosing to simply pick and choose over freight that they're loading at origin. And that's really created a backlog in freight, because if you reduce capacity and you reduce the amount that you're willing to load on those boats, I mean, inevitably, freight tends to get built up back at origin, and that helps to put that upwards pressure on rates. So like Zach was alluding to earlier, I'm really wondering, when is the rubber going to meet the road in terms of, what we expected would be a pretty significant decline in import volume. And that's mostly based on the consumer. So the Fed, I think, at this point, it's projected to cut or continue cutting throughout 2024. But I just don't know if it's going to be at a quick enough rate to help consumers who are starting to get in a real bind. So if you look at purchasing power, you look at these inventories, and now that these inventories have been bled out in a way where it's more of a just in time consideration from shippers, I think you're looking at some real potential for some significant volume drops. And so the rates that we were thinking, from China to the West Coast and East Coast of the U.S. to break through their floor they'd established in early April of this year, if you looked at the East Coast rates before the Panama Canal, they were right there at that bottom. So they would have broken through had this, pressure not been put in terms of what is able to be loaded on those containers going to the East Coast. And just any excuse possible. The carriers are going to use that to their advantage. War risk, there is a stipulation that they can charge if there's an increased war risk. I mean, and I think most people would see why. But all things considered, it's certainly something I'm watching is the strength of the consumer to try to better identify, are rates going to stay relatively stable through the beginning of contract season in early April, or is there some significant room to the downside? And if I was a betting man, I would say that, that they do have some significant room to the downside. I just don't know if at this point they'll actually break through that floor, because the rejections is something entirely new. We've just never seen carriers say, hey, we're just not going to load your freight if you're not paying enough.
Man, there's a lot there. we've got geopolitical risk. I think that's something that we absolutely have to consider from the maritime space. I think COVID has created an environment that's a little bit more divisive. This de-risking supply chains is absolutely contributing to some of these increased conflicts. And I think you're making a good point, especially now that the carriers are employing these new strategies around managing their rates or how much they can charge. So, Henry, thank you so much for coming out here today and giving us a heads up. We've got one more market expert here, Ryan Grody, our supply chain expert, has set to join us here in a second. But I think some of this also is a great segue for him in the way that Henry kind of dials it in the way that there's this geopolitical kind of surface level impact that can happen on supply chains that there's nothing you can do about it. It's almost unpredictable, but you have to be ready for it, it or not. Yeah. And then there's this underlying consumption, economic thing you have to consider. And then in the middle there's the carrier behavior component where they're trying to manage their capacity. So I think these are all extremely good, things to watch. Did we just lose Ryan? But
Ryan's going to be a great talking point for, especially on the shipper side. So when we're looking at how that interacts with going on that side, because we always talk about what's going on the freight side. We're always talking about what we're seeing on the carrier side. But when you can offer that type of perspective of what's going on his realm, on what the shippers are seeing or what they're dealing with, I think it's huge, because we've seen that pendulum just swing in the complete other direction. And
there's so much energy that's been injected into our space, especially economically, supply chain wise. They're obviously very connected. Right. And the fact that we are, I was talking with Tony Mulvey before the show about how there's just so much stuff moving around now from an economic perspective, so much inefficiency that I think is out there that's allowing our economy to kind of stay elevated. Right. Henry was talking about, in one of his articles about how he was forecasting lower demand in the second half of the year. I think that you and I agreed with that for the most part, because consumer debt levels were increasing so strongly. Does this still, and we've talked about it several shows, are we out of the woods yet in terms of economic stability? Right. And I think I've become a little bit more bullish. I don't want to call it bullish, but I'm still, slightly bearish, in 2024 economically speaking, because the debt levels have increased so significantly and the consumer conditions are just not great. Do you
Yeah. So one of the things I say always is I never bet against the American consumer, and is that they're going to find a way to spend some way, somehow, whether it's going to be credit cards, whether it's going to be emptying out savings, or whether it's going to be the new buy now, pay later wave that's really hit over the last year and a half or so. And I think when we're looking at that just unwavering demand, I think that's seen as a sign of strength and a sign of resilience, but I don't know if that's the correct way to look at it or interpret it. And I think it's almost more so of a worrisome trend and a worrisome sign that we're seeing that there's ongoing consumption. And I think we see it as a good thing, because we get things like a GDP number in the third quarter that's over 5%. We start to see, incredible amounts of service spending. We start to see that there's still demand for certain goods. And so I think there's that positive side that we take away from it. But the negative side is looking a little bit further down the road here and seeing that there is going to be some a weaker position that a lot of consumers are going to be in if there is a shift on that thing that I think is really holding this whole thing together, and that's going to be around the labor market. And if there's a shift in that labor market, that's where I think a lot of this, almost house of cards, if you will, starts to potentially tumble. And I think that's where some of those underpinnings really get tested on, okay, you say that household wealth is better than it was before the pandemic on certain reports.
Yeah.
Let's see for which demographic that holds true for.
Right.
Or if you see that, okay, demand is there and that there's this resilience, let's see how much that demand holds up, where that interest-free buy now, pay later starts to hit if you miss a payment and now you owe, up to 30% on something. Or maybe, you have an Apple Pay. Now they can control what's going on with your cell phone. So it's so many things that kind of go into that, car notes, things like that. So when we're looking at what's going on, those are going to be some of my concerns, and I think really all comes to a head.
Yeah, and from the shipping perspective, I mean, I think a lot of, some of the people that I've talked to lately, they have this ongoing concern. We talked to Zach Rogers a little bit ago about this. They expect prices to increase next year.
Right.
And that's something that, I mean, we haven't heard that and for months, if not over a year. And that's, I think that's the thing, is when do rates actually get pressure back on them? The supply-demand equilibrium, the shift is already swinging. It's in motion. We can see it moving, but we can't see that precise timing of when that motion clicks and all of a sudden carriers have pricing power once again, or service providers have pricing power once again. My outlook next year, and again, now that our buddy JP at the Fed has decided that, hey, we're pretty much done, and we actually are probably going to cut rates, as Henry alluded to. That to me is a signal that, hey, economically things don't look as good as that nominal GDP figure would suggest, and that also means that we should probably see a turn in the environment sometime in the next 12 months.
Yeah, and let's just go ahead and bring on our next market expert here, and that's going to be Ryan Grody. We're going to be going on through the old-fashioned telephone here. And
Donde está tu teléfono?
and he's going to give us a great perspective of some of the other talking points to really round this whole thing out, because we've heard from rail intermodal, CPG, what's going on the ocean side, going into some of the trucking aspects, what's happening on the shipper side with those supply chains. But we're looking forward to having Ryan on with us here shortly.
Yeah.
Ryan.
Yeah, Ryan, can you hear us?
As I saw a picture of him flash up quickly.
Oh, well. No, I mean, the idea is, I think the transportation manager side of things, they're waiting on rates to turn. Like, you set these contracts. We had bid season this year. It's implementing right now. At the tail end of this cycle, I've already seen it with several people. Like, at the tail end of the cycle, we are seeing capacity erosion. And it's not like it's dramatic. It's not becoming a thing that's creating, this huge and unstable environment. But those rates aren't capturing the same value that they were at the beginning of the year. And I think that to me is a sign that we are moving, like things are moving in that direction. And I don't know that we have 12 months left in it. So from a transportation management perspective, if you are setting your rates and your target costs, you need to set up some risk assessment this year. Last year, you could get away with it.
Right.
You know what I'm saying? Like, there was almost no, and I guess we're not going to have Ryan, but I'll try to talk for him here. But gotta love the internet. So the thing is I think from my perspective, I can't target costs as a pure motive anymore. When I'm talking to my C-suite bosses and people that I'm budgeting for and projecting, I have to say, look, there is a decent chance that by the end of the year, my transportation capacity and service demand needs are going to be misaligned with what the market can cover, significantly. And from that perspective, I don't want to end up as the low end person. Like, I don't want to be that value shipper because that means that's going to end up being a higher cost at the end of the year.
And I think one of the things that's going to be important as we look at, of course, the first quarter and going into the first half of 2024 is this expectation. Of course, there's the official, recession or no recession, or growth or contraction. I think you have to drill down a little bit deeper than that. You can't just have this blanket statement as is everything going up or everything coming down.
Right.
I think you have to drill into each subcategory that you might be operating in, each vertical, because I think there will be certain segments that are going to experience some parts of recession while others show some areas of opportunity at the same time.
100%. I think that's been the big, thing at the end of COVID we've all learned is that these aggregate figures sometimes don't do a great job at measuring granularity. But 2023 in the books almost, 2024 looking like, at least directionally,
I'm concerned. I'm still
not
concerned.
economically out of the woods, but maybe transportation.